Hi folks, and welcome back to Meaningful Money. Well, here I am back at the Merry Maidens. I was here for, I believe it's episode 31, talking about shares and using a stick as an example. Remember that one? The Merry Maidens is a stone circle, 19 stones, said to be the petrified remains of some maidens who were caught dancing on the Sabbath, and that was their punishment, to be turned into stone. Not far from here is two other stones called the Pipers, and they were the musicians for whom who were playing for the maidens, and but they tried to run away when they heard the St. Buryan clock strike midnight, and they realised they were going to be playing on the Sabbath, but they didn't make it, and so they're a little way away from here and turned into stone as well. Bit of a rough lot really for just having a boogie on a Saturday night going into Sunday morning. See, Sabbath and all that, right? Okay, we've been talking about personal taxes. We've done income tax and national insurance. Moving on to capital gains tax now. Now, capital gains tax is levied, that means charged, on the increase in value of something you own when you dispose of it. That means you sell it or you give it away. So it's the increase in value of something that you own. Capital gains tax was brought in 1965, but it's only charged on the increase in value, the gain, since 1982, 31st of March to be precise. So if you've owned something a very long time, then the only thing you're going to get charged on if you flog it now is the increase in the value since 1982. So what is a gain? Well, the sum is dead simple. If you have a thing, an asset, the gain on it is worked out as follows. It's the sale price less the purchase price less any costs you've incurred along the way. It's pretty straightforward enough. It's the difference between what you sell it for and what you bought it for, or what you sell it for and what the value of it when you received it as a gift, say. Plus you can take off any costs in the meantime. So if what we're talking about is a property here, not your main house as we'll mention in a minute, but say a second property, a rental property, if you've done any maintenance on that property in the meantime and you incur legal costs and things like that when you come to sell it, all those costs can be taken off the gain. And what's left is the net gain, and that's what tax is chargeable on. So what things can you have capital gains tax charged on? Well, as we just said, property and land are big ones. Shares also, funds which hold shares and the like. Currency is another one, so not sterling, right? But it is possible to buy and sell foreign currency for an increase in value as an investment, and if you make a gain on that, then tax can be chargeable. Certain things, though, are exempt from capital gains tax. The one I've just mentioned is your principal private residence, your home. You can't get taxed on that when you sell it. Neither can you get taxed on things like your car, or what we call the chattels in your house. That's the furniture and the TV and stuff like that. But if you happen to have a Chippendale sideboard or something like that, which is worth tens of thousands of pounds, well, you might get taxed on that because the chattels exemption is only for things less than £6,000 in value. National savings, premium bonds and stuff like that, no capital gains on those. Neither is there on gilts, that's government bonds. Assets held in an ISA. One of the main benefits of ISA is that they shelter your funds or your shares or whatever from capital gains tax. And finally, any proceeds you make from a bet or doing the pools or the lottery or something are free of capital gains tax. Also life assurance policies, if you sell one of those or surrender an investment bond, no capital gains on those either. So those are the things which capital gains tax can and cannot be charged on. A few more things you need to know. Firstly, everybody gets an annual allowance. A little bit like the personal allowance for income tax, the annual allowance for capital gains tax is the amount you can gain in any tax year without paying any capital gains tax at all. And that amount is £10,100, and everybody gets one of those. So if I flog something and make a gain of £5,000, there'll be no tax to pay because that £5,000 gain is within my annual allowance of £10,100. There's also no capital gains tax if I transfer something to my wife or vice versa. Gains on transfers between spouses. Let's say I get left a property by a distant aunt. Chance to be a fine thing, eh? And I decide to give that to the love of my life, my good lady wife. Well, even though I've had it and disposed of it, if it has gone up in value in the meantime, if I'm giving it to my wife, then there's no tax to pay. An inter-spousal transfer, no tax at all. And that's a useful planning angle, something we use quite a bit. If a client wants to dispose of something, sell an asset, we always look to see if we can perhaps do an inter-spousal transfer to reduce the tax payable. There are excuse me, certain ways you can what we call hold over or delay capital gains. I'm not going to complicate things too much with those. Certain schemes which the government came up with to encourage investment in enterprise. You can, if you make a gain, you can reinvest in one of these schemes and offset your, defer your gain for a while. They're called enterprise investment schemes. The final thing, though, to mention is that losses, any losses you've made, we talked about gains so far, but what if you lose money on selling something? Well, if you lose money, you can offset that against any gains you make. So let's say I make a gain of 20,000 quid selling something, but at the same time I've sold something and made a loss of £5,000. Well, the difference between those two numbers, 20,000 less 5,000, is my net gain. So I'm only going to get charged on the net amount. That I can offset my losses against my gains. And those two sort of transactions, the loss and the gain, don't have to happen in the same tax year. I can carry forward any losses for 5 years and 10 months after the end of the tax year that they are lost in. So that's a useful planning tool as well. We'll come back to some of these things, though. Now, that's what they're charged on and what they can't be charged on and various allowances and reliefs and stuff. What about the rates? How much is it? Well, we've talked, remember, in income tax about tax being charged in bands and your income being stacked against those bands to work out how much you're charged. Well, when working out capital gain, since June this year, that's 2010, any gain you received or you make is added to the top of your income. And if that gain takes you above or into the higher rate band, then you will pay 28% on the bit that's in the higher rate band. On any gains which keep you within the basic rate band, that's 18%. So, to put it another way, if you put your gain on top of your income and it keeps you in the basic rate band, there's 18% to pay. If it takes you into the higher rate band, then whatever is in that higher rate band is taxed at 28%. Make sense? Hopefully. As ever, leave any questions in the comments thing below and I'll do my best to answer them. But that's capital gains tax in a nutshell. So next time we're going to talk about the last of the 4 major personal taxes, and that's inheritance tax. That'll be quite a quick one. They call that the voluntary tax. Yeah, we'll see. But from the Merry Maidens, the poor ladies turned into stone for just having fun on a Sunday. Thanks very much for watching and I'll see you next time.